If you want to invest in property, then understanding how a buy-to-let mortgage works is going to be absolutely fundamental to your success, as this is really going to be the key way to leverage your money and really accelerate your results, along with actually enabling you to work out what properties are going to make good investments and bad ones very quickly, making your research process so much easier. But if you are new to the channel or just my content in general, my name's Ali. I am a mortgage broker based in central London. I've helped tons of people buy and invest in property, really guiding them through the entire buying process, which is what my aim is today for you in this video. And on this channel, I cover topics on personal finance, property, and investing. So if you want to learn more about those topics, you're definitely in the right place. So make sure you subscribe down below to stay up to date with all new content. But before we go any further, I really appreciate it if you hit that like button down below. This is a very, very new channel, so every single like goes a really long way. So if you could just do that for me, I'd really appreciate it. Now, in regards to this video, what we're going to do is go step by step through the whole process, which is first going to cover off the basics of a buy-to-let mortgage. So do not worry if you're completely new to the subject. That's going to bring you right up to speed. And then moving on from that, we'll talk about how to know whether a purchase is going to be achievable or not, which will cover things like all of the costs involved for yourself. And then we'll move on to talking about the different ways you can make a purchase, because there are a couple. And then to finish it all off, we'll go start to finish of the whole buying process, which will nicely tie together all of that information. Now, with that said, let's jump straight into the video by covering off those basics first. Now, as the name suggests, a buy-to-let mortgage is where you buy a property with the intention of letting it out. So that's not going to be where you buy a property with the intention for yourself to live in, or for any of your family members to live in. Now, the easiest way to try and understand a buy-to-let mortgage is by trying to imagine the property as almost like a business, and the rental income it's going to generate from potential tenants is almost like the revenue to that business. And because lenders are basically going to be investing in the property with you, they're going to want to assess whether there is a strong rental demand in the area you're looking at buying, along with what the expected rental income is going to be, because that's actually a key factor in determining the maximum loan size available to you. The other key factor alongside the rental income is going to be how much you're putting down as a deposit. Now, with investment properties, you're going to need to put down an absolute minimum of 25% of the overall purchase price. Now, what that also means is that your maximum loan size is going to be capped at 75% of the value of the property. So even if you were trying to buy a property for £100,000 and it generated £4,000 in rental income each month, then your maximum loan size is still going to be capped at 75,000, because that is obviously 75% of 100,000. And on top of the deposit, you're actually going to need some extra funds to cover off the other upfront costs involved in the home buying process. The largest of which is more than likely going to be your stamp duty bill, which is basically just a tax you pay once you complete on the purchase of a property. Now, with investment properties, you're going to pay these stamp duty rates, which are just the rates you pay if you're moving from one main residence, which is a property you live in, to another one. But because this is an investment property, you're going to be charged a surcharge of 3%. So it's going to be these rates, but plus 3%. And to actually show you how much you can expect to pay at different purchase prices, here are a few examples. And as you can tell, this is definitely not a cost you should be overlooking, because it can be a big upfront cost to you. The other upfront costs we need to take into account are going to be things like your solicitor and broker fees, which collectively might be around the sort of £2,000 mark. And then once you have a mortgage offer from a lender, which is basically just them inviting you to accept the funds you've applied for, then what you should do is instruct a further building survey, because what this is going to do is tell you all of the details you need to know about the property and its condition. Now, this is probably going to cost around maybe £700, £800, but it is an absolute vital cost that you cannot skip out on. This can seriously save you maybe tens of thousands, and in really serious cases, hundreds of thousands, if you buy a property that's just complete garbage. And lastly, you may actually wish to furnish the property you're looking at buying just so you can charge that little bit more each month in terms of rent. Now, for a 2-bedroom flat, this might cost maybe 2,500, but that amount is obviously extremely flexible in terms of whether you actually want to do it or not, and in terms of the sort of quality of the furniture you want to buy. But if you're still a bit lost on how much this is actually all going to cost you, let's just assume you're buying a property for £200,000. Well, then you're going to need an absolute minimum of £57,500, because what that covers is the 25% deposit and your stamp duty, which are the fixed costs involved in the transaction. And on top of that, you might need maybe 4,000, 5,000 to cover the other upfront costs, which I've just mentioned. But these bits are a bit more flexible in terms of the quality of maybe the service you want, or even if you want to furnish the property. So to really quickly summarize, the 2 key factors for determining whether a buy-to-let purchase is going to be achievable or not are going to be the rental income the property generates, along with how much you're putting down as a deposit and the other savings you have to cover the other upfront costs. All of this means that your personal finances actually take more of a backseat role in the whole process. And that's because the main focus is on the property itself and less about you. Some lenders will even have a no personal minimum income requirement. But if you do have quite a low income, lenders will just want to ensure that 100% of your savings aren't going towards the purchase, just to ensure that if you're not able to rent the property out for the first few months, that you're still able to cover the actual mortgage payments. Having said this, your personal income and the method you use to make the purchase can actually affect the minimum rental income needed to achieve a given loan size. And what I mean by this is the minimum monthly rental income for someone who is a basic tax rate payer is actually going to be lower than that of someone who is a higher tax rate payer. So to achieve a loan size of £100,000, if you were a basic tax rate payer, the minimum monthly rental income needs to be around £860 for the most flexible option. Compare that to if you were a higher tax rate payer, then for that same most flexible option, the rental income needs to be around £1,000 a month. However, this example assumes that you're buying the property in your own name, so you as an individual own the property, which is the first method of actually investing in property. Now, the second method is to make the purchase via a limited company. Now, this can be really beneficial for those who fall into that higher tax rate bracket, or if you're just someone who wants to minimize your tax bill to basically just buy more and more properties a lot quicker. As if you're a high tax rate payer and you make the purchase via a limited company, the minimum monthly rental income is going to be treated the same as if you were a basic tax rate payer. So basically, just less monthly rental income is needed to achieve a given loan size. Along with the fact that buying through a limited company actually means that you're able to write off a lot of expenses, which will basically just reduce your net profit, which is the amount you pay tax on. So that would obviously reduce your overall tax bill. So without going into too much more detail about buying in your own name versus a limited company, the real headlines are that if you want the rental income from the property to pay for your lifestyle, then you should consider buying in your own name, simply because if you make the purchase via the limited company, you'll pay both corporation tax and personal income tax when you withdraw the funds, so you're actually doubling up on tax. Whereas if you're someone that just doesn't want to touch the rental income and you want to store it to buy more property, then buying via the limited company might be the better option for you. But if you do want to learn more about this, I'm going to go into a lot more detail on it in another video, so make sure you subscribe to stay up to date with that. Now, to tie all of this information together, let's go through the whole buying process. The first step is to assess how much in savings you have to commit to the purchase, because that's going to let you know what properties fall within your budget. And then what we can do is worry about the rental income later. Now, as mentioned in the video, this is going to be that 25% deposit, your stamp duty, and maybe 4,000, 5,000 for the other upfront costs. Then the second step is to really start your research, find out the location you want to buy properties, see what's within your budget, speak to agents, go on viewings, ask them how much they expect the rental income to be. And once you find a property you want to buy, then what you want to do is work out whether that rental income is going to be sufficient for the loan size you need. Now, to work out whether this is going to be sufficient or not, you have a couple of options. You can either just Google a buy-to-let calculator and figure it out yourself, or you can speak to a mortgage advisor who will be able to search the entire mortgage market for you and let you know whether the purchase is going to be achievable or not. Once you get the green light on the rental income, then you have the ability to actually make an offer on the property. Then once this is accepted, what you want to do is submit the mortgage application and submit all your documents that are requested by the lender. Then once this offer is accepted, your solicitor will guide you through the rest of the journey. Then from there, what will happen is you'll exchange on the purchase and then complete on it, which basically just means that you now legally own the property. And then from there, you just want to get the place rented to start gaining passive income every month. And once you've done that, you successfully invested in property. Now, I know there's a lot of information in this video, so if any of it was unclear or you just have any questions in general, be sure to get down in the comments and let me know, and I'll be sure to get back to you. And if you did enjoy the video or you found it helpful in any way, I'd really appreciate it if you hit that like button down below. Like I said, this is a very new channel, so every single like goes a really long way. And if you do want to learn more about personal finance, property, or investing, make sure you subscribe to the channel for more future content. And with that said, thank you so much for watching, and until next time.